Managing Director of Strategic Income at Eagle Asset Management. James, it's great to have you. I mean, do you welcome these kinds of, let's call them quote unquote opportunities, or are you getting more nervous about just how much the Fed might be hiking here?
No, Kelly, it's actually it's quite an exciting period to look at this kind of volatility in the Treasury market and the outflows from the mutual fund passive complex. As we speak, we're looking on a Friday afternoon at offerings in municipal finance that were cheaper than they were just a couple of days ago. We're going through the first quarter with the worst quarter we've had since 1994, and there's a lot of trepidation in the clients and advisors that I talk to, especially because if you remember, Kelly, most of the municipal investors, they're baby boomers. They're of that 60, 65 demographic. They remember 1979. They remember gas prices, and there's an extrapolation that's going on and a little bit of concern, but we can calm those fears down and look for opportunities.
Although, it's funny, if you go back to the turn of the year, there was some pressure on muni bonds, but it didn't seem like that big of a deal. Now, when we have people casually talking about hiking by half a point or a full point or 4 half-point rate hikes, or we're going to 3%, I mean, the muni space, the entire space has to reprice for that.
Across the entire spectrum of fixed income instruments. Look, This is a different conversation, but the Fed has to do a catch-up here. They have to do it for the inflation reasons, which are more menacing than they believed. They have to do it for political reasons. This is a regressive tax on most American consumers, and they may be a bit behind. We can argue back and forth whether that's the case, but they are going to be aggressive. They're going to be front-loaded, and they're probably going to be a couple of hikes. Now, most of the curve that we invest in has already moved, so there are very, very good opportunities, but we are at probably maximum levels of unsettledness, if you will, in the individual investor space.
Maximum unsettledness, and yet we thought we might have been there a couple weeks ago or a month ago. We really haven't seen this bad bond performance in a long time. So can you be sort of opportunistic? If I'm, an owner, a holder of muni bonds, are there areas where I can go, okay, on a 5 or 10 or 30-year horizon, I can feel comfortable with the yields they're offering me?
Yeah, I think, Kelly, you have to look at the form of which you own the asset. If you own the asset in real bond form and you have a financial plan and an asset allocation, you absolutely should be legging into these levels. As you mentioned at the top, in our multi-asset class income strategies, we've been underweight the fixed income area. We have underperformed the broad equity income space in municipal finance. And as we look at that performance disparity, we start to readjust. So this is an opportunity for us to reallocate. We're looking very much at that 10 to 15-year municipal area where yield ratios are even more generous in nominal terms to the Treasury rate, and we're getting the tax benefits for free. So, yes, it's coming our way.
And you have, these are kind of specific, but muni investors will totally know what you mean. You like service revenue bonds, water, sewer, electric. You like, local GOs, general obligation bonds in higher population growth areas, Texas, Florida, Colorado. I think the strong housing market is a tailwind. What other details would you add for people who are looking for opportunities?
Well, I think you hit the highlights there, but I would also just remind people that post-COVID, in a kind of irony, the municipal finance market, municipal credit is actually in better shape, both from buoyed equity markets and some of the pension areas that had some trouble. Obviously, the housing market, which you've spoken about, revenues and migration patterns all matter. But when we have a discernible revenue stream, when we know the issuer, we know the financials, this is not a municipal market that's struggling because of credit. It's a municipal market that's struggling because of rate moves and flow of funds. And both of those, we think, will settle out pretty significantly in the back half of 2022.
And finally, you said you're looking in the 10 to 15-year horizon?
Yeah, and what we do there, Kelly, because those relative values are so cheap on a relative basis, because there's very few people willing to take that duration risk, if you will, we offset that kind of in a barbell fashion, if you will, with some shorter term in the portfolio to, in aggregate, give us an intermediate term sort of exposure, but not put us in that belly of the curve, which is most vulnerable, we think, right now to rate moves.
All right. Again, these are dicey times for all fixed income investors, muni investors especially. James, great to have you. Thanks so much.
Shepard Smith here. Thanks for watching CNBC on YouTube.